Hello my fellow freedom builders and welcome back to the channel. Many of you have requested a new video about sector rotation. I made one a while back saying that we might be on some sort of top of the market, and I did that by looking at what sort of sectors that were moving at the time. And some of you have written me and said, could we please get a little update to see where are we actually in the market? And yes, of course, I'll make that today, and I'll also get a bit into some of the financial news, because that is one of the things I'm doing in my Danish subscription service pretty much every single day. I'm trying to look at the macro picture in the world. And it's not because I have all of a sudden become a macro information trader, but I think it is very important to try to understand what sort of financial regime we are in the market right now. It's not that I'm trading directly on it, but it can give me some idea as to which stocks will move more in the future, so that if I'm sitting one night with 10 different buy candidates and I have only liquidity to buy 2, then this macro picture can give me a good idea as to where is the overall market moving. So if you have seen my first video, you might recall that the blue cycle here is the financial cycle, and then we have the red cycle, which is the stock market. And the stock market and the financial cycle, they are not moving in tandem, or they actually are, but it is displaced a bit to the right here, meaning that the stock market is, in theory anyway, a bit ahead of the financial cycle. So let's try and have a look at where this sector rotation model actually tells us that we are. First of all, I should say that this video is sponsored by the NSB, the NS Broker, which is my new sponsor here on the channel. You might have heard me talk about them the last couple of videos. It is a good Forex commodity index broker, and I'll talk a bit about it in the last half of the video here. But thank you for the sponsorship to NSB. I'll put a link to them below that you can follow if you want to see more about them. Okay, let's go to the sectors. Now, what I found here for you in the last video was on stockcharts.com. They have this performance chart where, and I think this is in the paid version, but where I can choose all the sector ETFs and compare them to the SPX, meaning the S&P 500. Meaning that when you're looking at these graphs here, what you're seeing is not that energy have been doing minus 13.15% over the last 60 days. No, it has been doing 13.15% worse than the S&P 500. So if I'm removing this one here, you can see how the different ETFs have actually been doing. But I want to see it towards the S&P 500 because, as you know, I like to see some stock or ETFs in their relative strength. So what we can see here over the last 60 days is that the industrial materials and energy have been, and stables have been doing quite badly here. But if we try, and as you might remember, we can move this slider and we can see how, for instance, here in January to April, we can see that industrials, materials and energy was high. And I said that I suspected the stables, healthcare and utilities to slowly get more into play. And let's see what we can see. You can follow the date up here, and we can see that they are starting to move here. We've gotten some financials also due to some interest rate hikes, and what we can see is a bit of movement to the right here. Now this is a 60-day cycle, so it can be a bit hard to see the exact movement here. So what I'm gonna try to do now is that I'll just keep it here, but instead of 60 days, I'll try and make it 50 days and 40 days, and you can see how it develops. 40 days, it's pretty much equal here. Then over the last 30 days, we can see that we actually have, well, stables is just about break even. We have some materials here, but we also have healthcare and we have utilities up along with financials and real estate. Real estate have been a bit winner lately. On the 20-day, we really see some, that's over the last month here, the last 20 trading days, we can see that healthcare and utilities are really starting to pick up. This will never be a perfect cycle as we saw it here, but this is just to give us an idea as to what is moving right now. And it seems like at least here we have some healthcare, we have some utilities, we have some stables. They are moving here. The problem is, of course, that tells us that the overall financial system is maybe getting closer to some sort of top level. But the problem here with the model is that it also tells us that we ought to be somewhere in a market decline right now, and we are not. If we are looking at the, let's just have a look at here at the S&P 500, does this look like a decline in the market to you? No, of course not, not at all. This is a huge bull trend. And one of the reasons for this, and this is why these are great theoretical models, but in real life it can easily be disturbed by all sorts of factors. The financial system is what's called a chaotic system, like the weather and so on. It means like you can never really predict anything, but you can get some indications. And I suspect that if we didn't see one stimulus package on top of another, on top of an infrastructure plan, on top of these unemployment checks and so on, we would have seen a downturn in the market. That's what I suspect. But that doesn't really matter, and that's why I'm more of a chart reader than I am of a fundamental investor. Because if I had just looked at the model when I made the video last time, I would have sold all my stocks and maybe getting into some defensive ETFs, bond ETFs, but the market has just been going up and up and up and up, and that is why I am a trend follower. But that doesn't mean we can't look at the chart and saying, yeah, okay, well, if at some point we can see some disappointment in the market, some infrastructure plan that falls apart or something like that, we might come to see an even bigger drop than we would have originally. But that is speculation. But that is where I suspect we are right now. We are somewhere here, and in a, you could say, normal market without trillions and trillions and trillions of dollars of stimulus, I think we would have been in this downslope right now. Maybe not a crash. I know this it looks like a huge crash, but this can just be a minor correction, 10% down in the market, and I'm pretty sure that will come eventually. So that's just to give you my idea of where are we on a on this sector rotation. Now, another thing I think is important to notice is the financial news. Now, I'm normally using my FX book here, where all the news are. This is for the week, and as you can see, there are some different medium, high, and low impact here. Now, what that's mostly the impact on the Forex market. I'm also trading Forex, so it's nice to know if there's some really huge news coming out about that could affect the dollars, some job openings or something like that. Now, the reason why I'm following this is that right now there's a lot of focus on the interest rate and inflation. And the reason why I'm looking at that is that the hotter the economy gets, the more speed we have on the economy, the more inflation we will get, in theory anyway. When there's a higher inflation, we will see an interest rate that is getting pushed up over time. And that doesn't necessarily mean that the market will crash, but it does mean that if the market is extremely leveraged, the companies have been borrowing tons and tons of money at almost 0% interest, then just a little hike up in the interest rate will mean a lot. So what I'm looking at here is, are there any indications that the economy is getting more and more heated? And now we don't have last Friday with here, but that shows us the non-farm payrolls, that there was a lot of jobs, more than expected, getting on in the US market. So that is an indication of more people getting into work, more people get more money to spend, meaning that it will pressure the prices up. Now we should say that Fed, the Federal Reserve, the central bank of United States, they have been saying all along that the inflation is just transitory, meaning it's just temporary. It will get back to normal. And that is a good question right now, is if that is really the case. If we're taking a look at here, we have some job openings. We can see that it was expected around 9.2 million job openings in the United States, but they were actually above 10 million, meaning that a lot of job openings are there, more than expected. And that could lead the employers to maybe get tempted to offer some higher salaries for the employees, because it is harder to get hold of people to do these jobs. There are a lot of theories as to why that is. If we're looking down here, I'm mostly looking at the yellow and the red, a bit into the European, but actually mostly at the US here. And we did have some, let's see here, that was some labor cost, non-farm productivity. I'm not looking too much on that. So Tuesday, there was not much indication here. When we are going into Wednesday, we could see here, that was yesterday, and that was very interesting. Now we have something called the Consumer Price Index, the CPI numbers. And there is the, you could say the normal numbers, the CPI here, month over month, meaning what has the change being from last month to this month. And then we have year over year, where we are looking back a year. Then there is the one that my FX book and everyone pretty much think has the highest impact. And that is the CPI that has been modified. And that means that they have taken out food and energy. And if you ask me, that is completely insane. Because if you're looking at the general population in the United States right now, you could see that many of them are struggling. And fuel, energy, food, they are some of the top priorities in a normal family when they are allocating their money on a month-to-month basis. So looking at it without food and energy is absolutely crazy, if you ask me. But let's have a look at it. Now, the news yesterday said that the inflation numbers had gone down, so Fed was right. This was just transitory. Yeah, well, first of all, it has gone down from 4.5% over a year to 4.3%, which is not very much. Another interesting thing is that if we look at the numbers here from July to August, they started to go up quite quickly here. And this entire transitory talk from the Fed has been that, yes, the inflation is high right now, but it is because we are comparing to such a low number last year. Okay. Well, when the inflation is going up by almost 0.5% here a year ago, then it is strange that it is only dropping 0.2% up here, meaning that it should actually have dropped significantly more. But that is a detail I don't understand why more journalists, financial media is not clinging on to. However, what I do like to look at is just the year-over-year consumer price index. That one was 5.4% last month. It was expected to drop to 5.3%, but no, it was still 5.4%. And well, it seems like it is quite high here. It's staying up there. I don't really see this being transitory, but maybe that is just me. Now today, Thursday, we're getting some new numbers here that is not talked about so much in the financial media, but I think you should have a look at. First of all, there is, of course, every Thursday we get the initial jobless claims, meaning how many new jobless claims are there over the last week. This have been dropping. Normally before the crisis last year, this was around 200,000 every week. So this is still double the number, but it is slowly declining. Now, what I think you should look at here is the producer price index. And again, they have said this is medium. And then if you include the food and energy, they are saying it has a low impact, which is strange. Because what we see here is actually the inflation on the cost for the producers. So when a US producer is to produce some goods for the American people, they are having a huge increase in prices. As we see here, 7.3% year over year have the prices for the producer increased. That is due to commodity prices, to a push up in salary. People demand more for the job they are doing. It is the transportation prices right now. There is a bubble in this container transport economy here. There is a lot of supply crisis, so the manufacturers have problem getting the right spare parts for the production they're making. So there's a lot of stuff going on in here. But as you can see, 7.3% last month and 7.3% this month, meaning that the costs for the expenses for the producers, for the manufacturers are skyrocketing right now. And where do you think they will put this extra cost on? Are they just going to swallow that and say, yeah, well, we'll keep the prices low for the consumers because we are just in this to make the world a better place. So we'll just make sure the consumers can get their cheap products. No, of course not. Most of these companies are shareholder owned, so they have to produce higher and higher revenues, higher and higher bottom lines. So they will, of course, put this extra inflation out on the consumer goods. So believing that the CPI will drop dramatically in the near future, as long as we have producer prices that is going up more than 7% per year, that is simply insane. I don't see that happening. Otherwise, if it does, it must be some weird manipulation with numbers. Because a lot of the larger manufacturers, that could be of dryers, washing machines, cars, etc., they are saying, yeah, well, we are raising the prices right now because we don't see any end to this increase in producer prices. So this is to give you some sort of idea of the thought process I'm doing on my day-to-day basis. I'm writing about this every morning to my Danish subscribers, so they know a lot about this already, but this is important to keep track of. If we think that the interest is going up, and we can just have a quick look here, if we are looking at let's just have a look at the interest rate. We have it down here. Let's have a look. Here we go. This is the 10-year interest yield, meaning that when that is going up, the bonds are going down. Basically, what we can see here, that since we got the NFP numbers last Friday, the interest has gone up. It was down at 1.12%. It is up at 1.35%. It has been a lot higher up here just a few months ago, up around 180, close to 180. I'm not sure we'll get up there just now, but there's no doubt that when the Fed at some time this year or in the beginning of next year will start to do their taper, meaning that they are decreasing their monthly purchase of bonds. Right now they are purchasing $80 billion worth of treasuries and $40 billion worth of MBS, mortgage-backed securities, each and every month. When they start to decrease that, we will see this interest rate go up, definitely. So sometimes next year, I suspect that Fed will actually officially go out and say that they are increasing the interest rate, maybe around summer, maybe in the autumn, but that will be my best guess. All right. I hope this was not too confusing. It was a bit fundamental, a bit macro stuff and not my normal technical analysis, but it's just to show you that this is also what I'm doing pretty much every single day, trying to get a picture of the overall macro situation. All right, take care of yourself and your money out there. And if you have any questions to any of this, feel free to write me either on the Facebook Building Freedom or underneath this video. Remember to like and subscribe and all that jazz. Talk to you again shortly. Bye for now.